So you are probably just starting out your journey and are overwhelmed by the amount of investment opportunities that exist. Don't worry, everyone has been there. Hey, I am the owner of TT. I've been investing for several years now and I read a lot of it on investing. In this video, I will show you 5 of the most known investment assets and compare them so you can find the best option. First, let's start with a short story. Imagine you're a part owner of your favorite coffee shop. Every time a customer walks in, you know you will benefit from the shop's success. That's what owning a stock is like. When you buy a stock, you're buying a tiny piece of a company, whether it's your favorite tech giant or a brand you just love. As the company grows, you share in its success, and the value of your piece can grow too. Imagine you've bought a piece of your favorite coffee shop now. As more customers flood in, your piece of the business becomes more valuable, and soon you're reaping the rewards, just like owning stocks. The pros? As the company grows, so does your share. Some companies even send you a little bonus called dividends. Like the coffee shop, giving you a cut of the profits just for sticking with them. Stocks also give you flexibility. If you ever decide to sell your shares, it's as easy as deciding to buy them. But here's the twist. What if business slows down? Maybe a new cafe opens next door or the economy takes a downturn. Suddenly, the value of your ownership might shrink. That's the risk with stocks. Just like a coffee shop that faces good and bad days, the stock market has ups and downs, and if the company struggles, your investment could lose its value. It's not like a savings account where your money stays safe. Now, let's imagine you're not just buying a piece of a coffee shop, but instead, you're investing in an entire group of coffee shops across the city. Some are doing great, some are just okay, but overall, you're less worried about any single one failing because you've spent your money across multiple businesses. That's what an ETF, or exchange traded fund, does. It's a basket of different investments like stocks, all bundled together. By buying an ETF, you're owning small parts of many companies, giving you a well-rounded mix of investments without having to pick individual stocks. Big ETFs are, for example, MSCI World that portrays the global stock market. The pros with ETFs give you instant diversification, so your risk is spread out. One company has a bad day, others in the ETF might be doing well, balancing things out. They're also super convenient. You can buy and sell ETFs easily, just like stocks. Plus, they often come with lower fees than some other types of investment, which means more money is in your pocket over time. But there are cons too. Even though you're diversified, the value of your ETF can still drop if the overall market takes a hit. And while the fees are low, they still exist, and over time those fees can eat in your returns. Also, with an ETF, you don't get to choose specific stocks. You're investing in a pre-selected bundle, so you have less control over what's inside the fund. Now, to our third investment. Picture this. Instead of investing in a coffee shop or a group of coffee shops, you're buying a new type of currency that only exists online. Digital money. Crypto. That's what investing in cryptocurrencies is like. Crypto, like Bitcoin or Ethereum, isn't tied to a company or government, but rather to technology and blockchain systems. It's decentralized, meaning no single entity controls it, and its value is based on demand. What people are willing to pay for it. The pros? Cryptocurrencies have the potential for huge gains. You might have heard stories of people buying Bitcoin early and making massive profits as its value skyrocketed. Crypto also offers a level of independence. It's outside the traditional banking system, so it can be appealing to those who want to escape the control of financial institutions. Plus, blockchain technology itself is innovative, and many believe it has the potential to revolutionize industries beyond just finance. But there's the catch. Crypto is highly volatile. Imagine your coffee shop's value changing every hour or even every minute. That's the kind of wild price swings crypto investors experience. Could you see your investment soar one day and crash the next? It's also largely unregulated, meaning there are less protections if things go wrong, like hacks or scams. And because it's still new, the future of cryptocurrency is uncertain. Governments might step up with regulations that could impact its value. Now, forget what I talked about. Imagine instead of owning a coffee shop or digital currencies, you're buying the building where a coffee shop operates. That's real estate investing. When you invest in real estate, you're buying a physical property, whether it's a house, an apartment, or a commercial space. It's tangible assets you can see and touch, which makes it different from stocks or crypto. The pros? Real estate has a reputation for being stable, long-term investment. Property values tend to appreciate over time, meaning the home or building you buy today could be worth more much down the road. Plus, real estate can generate steady cash flow if you rent it out, like earning income from tenants. Another benefit is control. Unlike stocks, where you rely on a company's management, with real estate, you can directly improve the value of your property by renovating or maintaining it. Finally, real estate can offer tax advantages like deduction for mortgage interest or property taxes. But there's the flip side. Real estate requires significant upfront capital. You need a large down payment, and if you're taking out a mortgage, there's the ongoing cost of paying it off. Then there are maintenance costs, property taxes, and unexpected repairs that can eat into your profits. Real estate is also less liquid than stocks or ETFs. You can't sell a house or building overnight if you need cash. And like any market, property's value can decline, especially during economic turnouts, potentially leaving you with a loss. Next, picture this. Instead of buying a coffee shop or a building or whatever, you're lending money to the coffee shop owner so they can expand. Wait, in return, they promise to pay you back with interest. That's what investing in bonds is like. When you buy a bond, you're essentially lending money to a company or government, and they agree to pay you interest over time and return the full amount, the principal amount, when the bond matures. The pros: bonds are generally considered safer than stocks because you're promised regular interest payments, kind of like a steady paycheck. Unlike stocks, where returns depend on the company's performance, bonds payments are fixed, so you know exactly how much you'll earn. Bonds also provide a way to diversify your investment and reduce risk. Even if the stock market is volatile, bonds can offer stability, and they can be particularly valuable in uncertain economic times. Government bonds in particular are seen as very low risk. But there are cons too. Bonds typically offer low returns compared to stocks. While they're safer, you won't see the same kind of growth potential as you might with a successful company's stock. There's also interest rate risk. If interest rates rise, the value of your bond can drop, making it less attractive if you want to sell it before it matures. Additionally, inflation can eat into your bond returns. If the cost of living rises faster than your bond interest, by purchasing power diminish. And although bonds are safer than stocks, they're not risk-free. Company or government defaults, you might not get your money back. As you have seen across these examples, every investment has ups and downs. Higher return often comes with higher risk, and higher safety comes with diminished returns. It is important for you to look at yourself. Do you have 1 million or just $100 to buy a house? Are you 16 and live with your parents? You can probably take a bigger risk than a 45-year-old that has to feed his family. It's completely up to your situation and your decisions. But there's actually something I didn't tell you. Professional investors hold all of them to maximize their gains. So if you want to know how they choose and manage their investments, subscribe to not miss the next video on portfolio management and other educational videos. Thanks a lot for watching. Bye.